The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN Friday morning, 9:06 a.m. We got about 24 minutes to go until the start of trading, and we got markets in positive territory. That's on the heels of a little bit of a jobs miss for non-farm payrolls this morning. We'll get into that in a moment, but right now we're kicking things off with the S&P charging higher, up 23 points, or that's a solid 0.5%, trading at 45.98. We are now more than 100 points off of the lows that you had on Wednesday's action. That sell-off on Wednesday, though, began about 50 points above where we're at right now. Quite the day on Wednesday, of course, with Chairman Powell talking about retiring, possibly the transitory theme, and yeah, that could have been Tuesday, actually, as I say that. Let me get that straight. But nonetheless, we're trading at 4,600 right now, 100 points off of the lows. We have the NASDAQ 100 up about 90 points right now. That's about 0.5% as well. Dow up 129 points, about 0.4% in the Dow. And we got the Russell right now up 15 points, trading at 22.20. We jump down to crude. Catching a little bit of a bid. You got crude up about $2 on the session. That's a 3% pop, trading at 68.50. Quite the acceleration for crude, where you back things up 62.43 yesterday. Quite a price tag, and we rebound nicely on the crude contract. We back down to gold. Gold contract up about $7 at 17.70. We were down to 17.62 overnight. You got silver right now basically flat. Is that correct? I got a little bit of a glare. I'm doing the show live from Isla Mirada, beautiful Keys in Florida, folks. We'll be back in the office on Monday, but you got silver right now flat at 22.31, and we jump to the all-important notes and bonds, basically flat. Interesting action. You see the volatility around the jobs number spiked to 131.03. We're back to 130.18. You are technically flat on the session right now on the 10-year. And we jump over to the Volatility Index to kick things off. The VIX this morning, 26.10. How about 32.61 on Wednesday's action? Yesterday sitting at about 28. We're sitting right now 26.10. Lower action compared to yesterday as we get a lift in the market, but still a very elevated level of volatility premium in this market. Okay, let's jump over to the headline number this morning. Jobs growth disappoints in November. It does not disappoint when it comes to the market trading higher, though. A gain of 210,000 jobs despite high hopes. The market was looking for, I believe, just over 500,000. Dow Jones estimate, they have 573,000 in here. You have the unemployment rate falling to 4.2% from 4.6%. Even though the labor participation rate increased for the month to 61.8%. You get the highest level since March of 2020. A lot of interesting action in here. A more encompassing measure of unemployment that includes discouraged workers, those holding part-time jobs for economic reasons, dropped even more, tumbling to 7.8% from 8.3%. The survey of households painted a more optimistic job picture, indicating a gain of $594,000 for the month. Leisure and hospitality, which includes bars, restaurants, hotels, saw a gain of just $23,000. That's not what you want to see, folks, if that economy is supposed to be opening up in a big way in terms of leisure and hospitality. Basically a flat month for leisure and hospitality in November, 23,000. Despite the disappointment, as they say, markets largely shrug it off. Excuse me. Now I'm going to jump around a little bit. That's not the one we wanted. We're going to stay on the jobs front for a moment. That's not it either. Let me get my story straight here. There we go. U.S. employment rate for November. Now, what was interesting here I was going to bring up is that you tie this back to, here's what I wanted to talk about. Bloomberg Intelligence's Rick Adano says that today's job report eerily echoes what transpired last year at this time. It is remarkable, folks, to think about how I sure did. We're clicking buttons. I apologize. I got muted there. Let me start over. So you got Bloomberg Intelligence's Rick Adano talking about the jobs report eerily echoing what transpired last year. So last year, November payrolls came in at about 245,000 versus the market looking for 460. This is when the vaccines just rolled out. They really started getting shots in the arms to the general public, whether it's February, March, and April. It was supposed to be the summer of reopening. You had November payrolls last year, 245,000 versus 460. You had the surge going on during the holiday season. And then you had what was another negative surprise, in fact, an outright decline following that number in December. It's amazing. It's been a year already. Hopefully that's not the trend that comes, folks, but you got to pay attention in terms of, you talk about the service sector basically adding any jobs. You see a miss of just about 200,000 versus a number looking for 500,000. And we're coming into the holiday season. And last year, in that similar time, a lot has changed. But nonetheless, you're talking about not what you want to see in terms of opening back up potentially on a rip-roaring economy, especially in that leisure and hospitality sector. If they're not even adding jobs right now, not sure what that means we go in the future, if maybe they've kind of reabsorbed all the employees they need at this time. This complicates the messaging from the Fed. I would agree with respect to accelerating the taper process if we're not adding the jobs. We got unemployment at 4.2% to throw in there as well. But nonetheless, the markets take that news and run higher as they see that potentially complicating, as they say, Chairman Powell. Maybe he came out as the bad cop this week talking about expiring transitory, meanwhile potentially leaving himself a little bit room if this data does not line up in terms of for the jobs. They might be in there a little bit longer on those rates, keeping them low to pad this economy. But nonetheless, we got the S&Ps right now sitting at 4,600. Let's jump around to some of the FANG stocks as we start off Friday action. Amazon shares right now trading up a bit, about $13. You're trading at $34.50. We kick it off with Apple. Now, Apple had quite a little sell-off yesterday, having to do with potentially a slowdown on their iPhones. Apple this morning going to be up about 25 cents to 164. Talk about some volatility from Wednesday to Thursday. You were at 170 Wednesday. That was when the market really sold off. Decent day for Apple, actually. Thursday, the slide really accelerated down to 158 at one point. You're up to 164. Now we pull up Apple. Excuse me. The news with Apple telling suppliers the iPhone demand has slowed as holidays near. Pay attention to this one, folks, because they make a lot of money off those iPhone sales. And as they put it in the first headline, byline, pent-up orders may not be as strong as once expected. Consumers are grappling with inflation and new COVID threats. The iPhone 13, folks, as somebody that waited to get the 12, to waited to get the generation of 5G, seems like there was a lot more impetus in terms of a lot more incentive, it was probably a better word, to get that 12 than there would be to get the 13. Of course, you're going to have, big upgrades across the board for all those Apple fans. But already, Apple had cut its iPhone 13 production goal for this year by as many as 10 million units, down from a target of 90 million because of a lack of parts. But the company has told component suppliers that demand for the 13 lineup has weakened. People familiar with the matter said, signaling that some consumers have decided against trying to get the hard-to-find item, especially, folks, when you think, if you got the 12, you got 5G. I mean, they're amazing phones. It's very hard to increase that number. We'll talk a little bit more about this when we get back. We'll talk about DocuSign, down like 30% today. Stay tuned, folks. We'll be right back.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
What's separating you from the most successful men and women on Wall Street? That's right, information. Having all the information gives us the perspective we need to place the right trades at the right time. The TAS Profile Scanner is the premier market profile-based scanner. Powered by its acclaimed TAS proprietary algorithms, this feature-rich scanner instantly filters over 2,500 plus global financial markets, such as stocks, ETFs, commodities, futures, and Forex. This powerful suite of tools leverages instant trade filtering and strategy formulation to show you emerging trades before they happen. For a limited time, you can save $100 off your first month by using the promo code UPGRADE, and you still get a 30-day money-back guarantee, so you have nothing to risk. Level the playing field with the TAS Profile Scanner, which you can find under the Services tab at TFNN.com. Sign up today.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern. For free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
Welcome back, folks. We got a chart of Apple up here right now. You have the S&P sitting up 20 points right where we kicked off the show. As I mentioned, you got about Apple up about 50 cents right now, trading at 164.20. Getting back into that Apple news. So, of course, you have them trading lower on Thursday. News of the suppliers across Asia and Europe. They extended their declines as well. The iPhone is Apple's flagship product. We're all kind of aware of that, accounting for about half of its $365 billion in revenue during the last fiscal year. And rolling out upgrades is a delicate dance. With the iPhone 13, Apple and wireless carriers unleashed aggressive rebate programs to spur purchases. In some cases, owners of the 12 or earlier were able to buy a 13 at little to no cost. While discount programs are still available, some offer less dramatic savings than when new models first came out. Now you look at iPhone owners in Japan show less enthusiasm for upgrading with the latest generation. When you look at who won't upgrade, right? So this is just one talking about consumers, okay? The iPhone 12, the black was that they won't upgrade. The 13, you're pushing 66%. All right, and 21% are thinking about not upgrading at all. That pushes that number to 88% almost. You're talking about only an 11% number is going to upgrade, where you get into the 12 and you're talking about 15.6. I'd say it's even more exacerbated than that, folks. As somebody that waited, I think I had the 10 to the 12 I waited to a couple. Maybe I was even at the iPhone 8. I forget, time goes so quickly, what I had before I had the 12. But nonetheless, there were a lot of people just like myself that kind of delayed, upgraded to the 12, and I see no reason whatsoever actually to upgrade from the 12 to the 13. I mean, if they're going to give me some huge rebate that makes it almost free, I'll consider it. But there's no noticeable difference in my personal life, at least for what I use that phone for, to upgrade that iPhone. Let's see. So during Apple's latest earnings call in October, you had CEO Tim Cook said that demand for new products was robust, fueled by interest in the latest iPhones, and that the company was on track for record holiday quarter. It had $111 billion a year earlier. He pointed to supply constraints as the biggest challenge. I mean, this is just to readdress what he said, folks. This is not supply constraints. Now he's talking about demand. Cook predicted that the struggle to get enough components, chips, would cost Apple more than $6 billion in revenue during the holiday quarter. I mean, it's staggering what the numbers are that some of these companies are putting out. All right, so keep that one on your radar, folks, because Apple's been a one-way ship to higher prices, and you start talking about that they're going to have trouble with demand for their flagship product. I mean, we just traded from a price of 138 to 170, let alone you back it up to just June, and we were trading at 124 for Apple, up to 170. Remarkable action for a company with more than 16 billion shares outstanding. Every single $10, folks, this company is adding $160 billion and change to the market cap of that company. So keep that in mind when you see that type of an acceleration. Now, speaking of accelerations, just the other way, DocuSign. Watch out for this one, folks. You go from 233 last night. We were up at 314 as recently as August. We're going to open at 155. I'm going to put this on a 3-year weekly. I'm going to pull up 155 on this chart. You're talking about breaking every single level we have in DocuSign, folks, going back to June of 2020. 155. Yeah, you're talking about June of 2020, and you're below everything else, and it seems like the next stop, folks, would be $95 on this equity because it was a one-way shot from the COVID lows of about $80. You accelerated directly to the 211 area. Now we pull up the 5-minute chart to see the acceleration on their news last night, and it just keeps dropping. You drop from about 233. We're sitting at basically session lows of 155.31 right now. Now to pull up the news on DocuSign, let's close out that ad. 30% after the company gave. Close out all those ads. Weak guidance. Don't want to see weak guidance in the big way. I mean, this is a strong company going forward, folks. But man, you talk about a haircut on their price. They predicted fourth quarter revenue is going to come in at 557 and 563. The market was looking for 573. Talk about getting punished. Analyst expectation for the third quarter, earnings per share of 58 cents compared to 46 cents, right? So they beat analyst expectations for the third quarter. They beat on revenue, which 545 versus 531. You have several firms, though, lowering their guidance following the earnings report. You have one analyst, Citi, maintaining a buy rating. He's got quite a price target of 231. Still from 389, though, is where that goes. One of the biggest whiffs in recent memory is what he calls it. Pandemic tailwinds came at a much faster than expected halt for DocuSign, catching the company off guard. JP Morgan's talking about, not quite what the market was looking for on DocuSign. It is a strong company. I was talking to my dad this morning about this, though, before I was coming on the show. And he was saying, they use the service for real estate, for transactions and stuff like that, and they do all the transactions online, but DocuSign is not the only one in that party anymore. There are competitors, one of which he's using. So yes, signing things online is the future, and the future is here now, but DocuSign, I guess, not capitalizing in the way that they maybe thought they would as of last night. You're trading down. Just remarkable. 155 on this company. And I'd be careful because as I put it on that chart, I believe in this equity in the long term. But, man, anytime you just trade below everything going on and you're in a one-way shot, to reiterate again back where we are. Now, that was a Fibonacci because I was looking at this one recently. But you're in no man's land here. You went from a price point in March to July, over 4 months. You went up 150% on this equity, and you're going to open basically towards the upper end of this run where you just had a one-way shot, and you're already in that position. Anybody buying this equity over the last year and 4 months, you're talking about the last 16, 17 months, is in a losing position immediately on DocuSign, let alone getting caught at the highs of about 300, where right away your money is all gone if you're on margin, which is remarkable for that quick of a decline. When you talk about, you're talking about, folks, 3 months ago, you buy DocuSign on margin and all your money's gone. I don't think a lot of people thought that type of an acceleration would have been possible. Yeah, and as our man Dan's saying in there, is that the crazy thing is they beat handily on the top and the bottom line, guided a little bit below expectations. And, I agree, Dan. I'm not sure what's in here because, to have some of these analysts, though, calling it one of the biggest software as a service whiffs in recent memory. Looks like maybe, that they were thinking that they either beat those expectations, beat that guidance, accelerate, because I agree in terms of the numbers that we're talking about in here, the numbers you're talking about there, it doesn't seem like it's the biggest whiff in recent memory. But nonetheless, the market making them pay and probably agreeing right now in terms of price, talking about trading down 30%. Don't see a lot of equities trading down 30%, especially when you beat on the top and the bottom line. right? And their guidance was barely $10 million potentially off what they were looking for. I'd be careful on that one because the market is a little worried to a big degree in terms of what's happening there. Okay, what else we got going on? Let's jump into some of those jobs. So we talked about jobs. Payrolls slowed in November while jobless rate fell. We had 210,000. Market was looking for somewhere between about 550, 575. Upwardly revised 546,000 job gain in October. Labor force participation rate actually going up to 61.8%. Median estimate Bloomberg has here at 550,000. Now, what I wanted to talk about, so among America's largest cities, 40% have fewer jobs than in 2016. That's a startling statistic. Among 51 metropolitan areas in the 2010 census, population of 100 million or more, 40% have seen a decline in employment levels compared to 5 years ago, folks. The world has changed. Come on down to beautiful Florida. Because that's part of it, folks, in a big way. Remarkable 40% though. We'll go into this a little bit more when we get back. Stay tuned, folks. We'll be right back with the open.
Are you having fun trading the markets, but having trouble finding like-minded individuals to discuss your trading and investment ideas with? Become an apex predator in the trading markets and join the Tiger's Den Trading Room only at TFNN.com. The Tiger's Den is an exclusive trading room where successful traders from around the world come to exchange trades and ideas. Join the den and surround yourself with the sharpest minds in the trading world. Subscribers to the Tiger's Den are also the first to have their questions answered live on air and can privately chat with our TFNN hosts live during their shows. Interact with other Tigers and Tigresses as they share trading ideas, news analysis, and discuss the market action all trading day. Subscribe to the Tiger's Den risk-free with our 30-day money-back guarantee and become part of the TFNN trading community. TFNN, educating investors.
You could be making money off the stock market. And if you're already making money off the stock market, you could be making a lot more. Check out TFNN and Tiger TV and get expert investing advice to give you the power to control your financial future. Go to TFNN.com and find the newsletter for you. Whether you're into trading gold, metals, futures, currencies, or options, you'll get advice and analysis to help you seriously get ahead. TFNN also features trading services with a 30-day money-back guarantee for new subscribers, as well as TFNN's Tiger Den Trading Room, trading software, and educational webinars for all trading levels. And make sure you check out Tiger TV for free on TFNN.com or TFNN's YouTube channel for live financial content from 8:30 a.m. to 4 p.m. Eastern on market days. Stop watching on the sidelines while other people get rich and become the investor you were born to be. TFNN, educating investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open. We got the S&P's up 18 points right now. NASDAQ 100 up 53. The Dow up 96. You got the Russell positive by 7 points right now. We jump over to the VIX as we open after that non-farm payrolls miss this morning with the VIX sitting at 26.15. Pretty remarkable that the market loves a jobs miss, but that's the world we're living in right now, folks, with the amount of stimulus and the Fed keeping rates where they are. That's going to determine a lot as we go forward in the coming months. Pretty remarkable, though, the number of misses we continue to get, it seems like, on the non-farm payroll numbers. Service and leisure now just adding 23,000 jobs, I believe it was, for this non-farm payroll number. Basically a non-existent ad for the sector that's supposed to be charging back and roaring back. Not quite the case. All right, jumping around to what else we have going on. Continuing the story. So as I mentioned, you got among the 51 metropolitan areas with the 2010 census of more than 1 million people, about 40% have seen a decline in employment levels compared to 5 years ago. Now, what's crazy is you look at where we are. These are cities with the largest difference between their 5 and 10-year job levels. You have the 5-year in the green, the 10-year in the red, and you can see the declines here going across the board. Whether it's San Jose, California, the biggest decline I think it stems from. You're talking about going from 23.3% on a 10-year level to just 2.5% on a 5-year level. Right? You can go down the list over and over. What do we got? We got any Massachusetts cities in there? No Massachusetts. In some cities, including several California ones like San Francisco and San Jose, jobs rose sharply in the 5 years through 2016, but have essentially stalled out since then. And in the 4 biggest cities, the pandemic rebound hasn't been strong enough to push employment levels back to where they were a decade ago. Yeah, look at in 4 of America's largest cities, fewer were employed than 10 years ago. Pittsburgh, New Orleans, Buffalo, and Rochester actually below those levels. Over the past year, all 51 large metro areas posted a decline in an unemployment rates as the economy reopened. The extent of the rebound varied substantially, though. Salt Lake City had the lowest jobless rate in October at 1.4. Oklahoma City was next. In the LA area, though, unemployment 7.1%. Just remarkable the trends that are changing the way we live, folks. Big cities are always going to be around. Boston, I miss that beautiful city all the time. New York is quite an amazing city as well. Can't wait to do a little bit of traveling when the world is a little bit more normal than it is now. Maybe my life slows down a little bit with a 10-month-old at home. But not quite the same deal in terms of people willing probably to pay the premium to live in a city, work in a city when you can work remotely, and companies probably enjoying that as well, as in probably paying for less office space. You're going to have to pay for less quality of living. You see a lot of companies already coming out in terms of if you're paying a wage for somebody to live in New York City, you're going to allow them the privilege to work from home. The option to work from home is probably a better one. Then, yeah, you might be paying them less money if they're going to work from home in a much lower cost of living state or city. I mean, if you're, working from home in whether it's Florida, whether it's Vermont, somewhere with a very low cost of living, those companies, they're going to assign that cost of living to the pay that they're paying as well. Now, everything is supply and demand, folks. So, of course, the best employees are going to get the best wages. It'll be a competitive job environment as it is now. But nonetheless, it seems like the companies make out on that situation just as the employees seem to enjoy that as well. All right, jumping around to some of the other headlines that caught my eye this morning. Berkshire's Munger says now is even crazier than the dot-com bust. Here's the only thing I'll add to this when I saw this, is that Berkshire Hathaway, an outstanding company, obviously, they've missed a little bit of the hayride here in terms of the extended bull run. Berkshire has been great at when the world ends and everybody needs credit and cash and nobody has it, they swoop in and get the deal of all deals, providing liquidity to some of the companies that need it. And that has just not happened, folks. It has not happened in a while. They've had a ton of cash. They've underperformed for a period of time. And so keep that in mind as you see that type of analysis, because, yes, eventually you will be correct. But I'm not sure this is even crazier than the dot-com bust, folks. Because, yes, valuations you could say are out of whack. I mean, NVIDIA is the one that comes to mind the most. I think I heard somebody say NVIDIA was trading at something like 60 times, 2023 numbers or 2025 numbers, something crazy. Okay, the multiples that NVIDIA is in right now is bananas. But guess what? the world needs chips, and they're going to need them forever. And they are going to ratchet up, and their growth is going to be tremendous. But the level of growth priced into this equity is tremendous, too. Now, here's the only other thing I'll say, though, is that multiples is one thing. The dot-com bust had companies that basically, do you remember, folks, if you're around at that point? I mean, I was even just barely out of high school, and even I remember the companies going public. I remember Ask Jeeves. Do you remember Ask Jeeves? Like somehow that was going to revolutionize the internet. Ask Jeeves went public. You start a search, an internet search that's supposedly going to compete with Google because they make it very simple that you can just ask simple language, English phrases on Google. Point being, of course, that company, they go public, they take in a bunch of money, they have no revenue, they just basically have an idea. They have an idea for an internet company. Anybody could have had an idea for an internet company, folks, push it out to the public, to the paper. Push paper out to the public. Quite a different story from what's going on right now. Yes, you have multiples that are very, very high, but a lot of these companies are making money or they're growing revenue. Some of them are dealing with some earnings woes in a big way. And yes, the multiples we're dealing with are tremendous, but a far cry from what we were dealing with in the dot-com bust. That's my opinion and take on that one. Okay. Let's jump to Mr. Elon Musk. He's continuing to sell those shares. I've said it early on, folks. If you don't think he was going to sell all those shares, then I would think that you would be incorrect. He's offloaded now more than 10 million shares. He needs to sell 17 million shares to reach the 10% threshold. So if you're a Tesla trader, I would factor in that Mr. Elon Musk is going to be selling 7 million more shares at some point in the near-time future. In the latest transaction, he got rid of 934,000 shares worth about $1.01 billion. Not a bad sell-off. Those were regulatory filings dated Thursday. The purpose of the sales is to help Musk offset taxes on the exercise of about 2.1 million in options. And there you are. You can see shares sold since November 8th. We're at just over 10 million. You got to get to 17 million to reach that number. And he's going to get there, folks. He pulled Twitter. He said he'd abide by it. My opinion is he already had a plan to sell those things off anyway. Wanted to throw a little bit of shade on the whole operation. And he's pretty much meandered this pretty fantastically, because if you think about any other executive selling a position like this, right? You got Tesla, all things considered. Okay, now this is a 3-year weekly. My goodness, back to $35 in 2019. That's quite a chart. 3-year weekly. You just back things up a year though. You're talking about from 539 back in this March. We're trading double that share price, folks, to 1,074. You see the run-up we've had. Yeah, we've been a little bit of consolidation since about 1243. Amazing that you're only talking about 1 month, but we're almost sitting at 1,100. You have the richest man in the world, the founder and the CEO of Tesla, selling off a $10 to $20 billion position in this equity. Nothing really dramatic, though, when you think about the size of his wealth. All right, folks, we got the S&Ps up 15 points right now. Tech stocks giving it back a little bit. NASDAQ 100 now just up by 11. The Russell giving it back, actually negative by 9. Check out the Russell on a 15-minute basis. There's a little bit of a sell-off on that open, folks. Russell just trading down 20 points. Stay tuned. We'll be coming right back. Are you in the market for buying or selling real estate in the Bay Area, including the surrounding St. Petersburg, Tampa, and Clearwater markets? Tiger Real Estate LLC is a firm that has extensive experience in the Tampa Bay area. Whether you're looking to sell your current property for maximum value, or you're in the market for a second home or investment property, Tiger Realty has the experience across all areas of real estate in the Tampa Bay area to help buyers and sellers make the most informed decisions across all price levels. From the price you should be paying per square foot in certain up-and-coming areas to the type of cash flow investment properties are capable of creating, Tiger Real Estate can help you make the best decision when it comes to all areas of the market. Before you make one of the biggest decisions of your financial future, call Tiger Real Estate LLC today at 727-329-8322 or email us at tiger@tfnn.com. That's 727-329-8322. Call us today.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, folks. I got a charted DocuSign here, so the slide continues right now. Now, this is a 3-year weekly I have up here, and I appreciate it, Dan, our man Boston Dan of the Den, talking about, we're right back to the 618. If you look at where this thing started, man, now, you can, maybe you start things off the run really on March 9th. You could take it from the point of August of 2019, where you're trading about $47, and you see we're back right to the 618 of that entire move from $50 to $315. Not a lot of people probably thought you'd see a 618. As I talked about, you could nibble there, and it's intriguing. That's the reason why I'm bringing it up for sure. But I'd be very wary of that. You are nibbling here. There's nothing to say this thing can't make its way back to $100 when you just traded from 315 down to 146, and you're down 37.3% in one day. Whew, watch out. All right, we got these markets trading lower. We got the NASDAQ climbing into the negative territory, down 20 points. Let's jump around to some of those FANG stocks. We got Google still up 0.5%. Apple up 0.4% right now. Microsoft shares up 0.1%. Did you just see that? Even those three I covered right there. Google, Microsoft, Apple, all positive. And you got the NASDAQ 100 down 34 points right now. I believe DocuSign is in there, so that's going to be hitting them in a big way, of course, as well. We'll jump to social media. You got Facebook shares basically flat. Twitter, big week for them right now. Twitter down 2%, continuing. That's a weekly chart. Let's check out the 15-minute action as Twitter dropping even lower. I think we're right at like session lows. Yeah, Twitter coming down basically for session lows, weekly lows, 41.75. We were trading at 53.20 on the early news that Mr. Dorsey would be stepping down. Excuse me as I get my mic all set. We were up at 53.20 on Monday on the news that he was stepping down. And this market, it's all sliding. We get the S&P is just barely positive by 3 right now. Bitcoin 56,000. Crude trading at 69.10. And let's see where that gold contract's trading at right now. Gold up about $10 at 17.73. All right, jumping around to other headlines. China, they're not messing around, folks. Didi begins plan for U.S. delisting Hong Kong share sale. Ride-hailing firm has come under pressure from regulators. Company said to target filing for Hong Kong sale around March. Now, check out the action on Didi this morning. So much for liking that news. Diddy jumps to 905 initially on that news, and just like that, we're down 8.4% on trading so far today. This stock, I think it's down about 40 to 45% from when they got public. Let's take a look at this and talk about the world changing pretty quickly. Do you remember when this thing went public in June, folks? It almost went public in July. Diddy went public basically 5 months ago. Imagine how much this world has changed since they tried to push that out. They thought they got it out. It trades to $18, and this thing's been chopping around since July 26th. It didn't even make it a month, folks, before everything basically got factored in terms of what was happening, in terms of regulators not being happy in a big way. And we've been chopping around, and we're still sitting in the sevens right now. Be careful of that equity. The world has changed over in China, folks. They have no interest in anything but China's prosperity, and they're just not going to let their companies become global behemoths that answer to nobody. They're going to keep them on those Chinese exchanges to answer to the Chinese regulators, and of course to answer to the president and dictator, President Xi, over there. All right, jumping around to what else we have going on. We talked about Elon. We talked about Berkshire. What do we got here? We talked about that headline as well. Yeah, so going over who is hiring, some interesting charts in here. The jobs numbers, who's hiring in America and who's not. So we added 210,000 in November. Unemployment's to 4.2%. Average hourly pay for workers rose 4.8% from a year earlier to $31.03 from $29.61. Now you look at where we are in terms of total number of jobs, still well under the number we had pre-pandemic levels. When you get into leaders and laggards and talking about industries, right? Science and sightseeing, scenic and sightseeing transportation, 7.12%. All right, that's a big number there. Couriers and messengers, 2.5% increase. Miscellaneous durable goods, 1.58. Performing arts and spectator sports, 1.5. Other information services, about a 1% pop. Now, on the negative side, though, motion picture and sound recording, down 1%. Travel arrangement and reservation services, not what you want to see in terms of where we should be going, down more than 1%. Clothing and clothing accessory stores, down 1.6. Sporting goods, hobby, book and music stores, down 1.8. I mean, look at the inclines. Scenic and sightseeing transportation, as we talked about, now above those numbers in terms of where we are. It's just really interesting how much volatility is priced into this market, folks, in terms of the number of economic numbers that are basically up in the air on a monthly basis right now, driving the action. I can't wait to see what Chairman Powell is going to try and say about the economy not adding jobs, transitory not being a word we should use anymore, and how he squares that with potentially keeping interest rates where they are. I would just really be aware that Chairman Powell may have really turned the toll this week, and I'm not so sure that the market should love weak numbers anymore on the jobs front if he is going to be worried about inflation. And you're seeing it potentially right now in the market as, yes, initially you saw a rise on that jobs miss, but as the market's open, I'm pulling it up, the market said not so quick. I mean, the Fed can't be in there at 0% forever. If we have rising inflation, the Fed chairman was out there earlier this week talking about that we have rising inflation that is no longer transitory. We now have jobs numbers that are missing to the tune of big numbers, folks. I mean, you know, I was talking about just with my dad and the people in the house this morning saying, you know, it seems like for a year we've been talking about misses. I mean, I started off the program talking about that last November, right? We had a miss. We were looking for about 500,000. Last November we had a 250. That was in front of a December that actually saw a decline. We were supposed to come out of the holiday surge with vaccination levels rising, causing the summer to be an opening level. Well, we got through the summer and all the rhetoric was, well, you just got to get kids back in school, which I agree with. All the rhetoric was you just have to have the unemployment benefits expire, which they did in early September. And still, we're not seeing the numbers, folks. All the rhetoric and all the excuses, okay, in terms of why the jobs weren't coming. Remember the summer. I'm just bringing it back because I'm not hearing a lot about it right now. During the summer, it was that kids are still out of school, right? You got to get kids back in school so that parents can get back to work. It was that you got to get the extra unemployment benefits pulled so that people have an incentive to start working again instead of taking the free government money. Well, what's happened, folks? It's December 3rd. We just got November numbers, and we only added 200,000 jobs. Leisure and hospitality barely added anything. And we have inflation that the Fed chairman himself, for the first time this week, said is not transitory. Add all those up, and I'm not sure it's a rosy scenario. And with that, you have the market agreeing with me. Down 1 point on the S&P right now. NASDAQ down 71. The Dow probably going into the red as we speak, but barely positive by about 14 points. And we got the Russell down 18 points right now. Pretty crazy action. Let's jump around to some of the travel stocks as we come into this final break of the show. We got American Airlines down 3.5%. The market does not like this news. Delta down 2% right now. United Airlines down 2.6%. We go domestically. JetBlue shares down 2.6% as well. Southwest shares, you're talking about down 2%. We jump over to the cruise ships. Carnival down 3% right now. Norwegian Cruise Lines down 2.6%. Airbnb basically flat at 169 so far. Stay tuned, folks. We'll be coming right back to finish up the show.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern. For free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Are you looking for a secured investment which pays you on a monthly basis? The Tiger First Mortgage Program may be the program for you. The best rate on a 5-year CD in the country right now, according to Bankrate.com, is paying 1% per year or $1,000 per $100,000 invested. The Tiger First Mortgage Program pays 7% per year, paid monthly, on secured, high-value, buildable properties in St. Petersburg, Florida. The investment is for 4 years, paying 7% per year, or $7,000 per $100,000 invested. Your investment is secured by high-value real estate in St. Petersburg, Florida. Your investment can be anywhere from $100,000 to $500,000. Do you want to make $1,000 per year on $100,000 invested, or $7,000 per year on a secured Tiger First mortgage? The Tiger First Mortgage Program may be just the program for you. The Tiger First Mortgage Program pays 7% per year, paid monthly. For more information, you can call 877-518-9190. That's 877-518-9190.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
And just like that, the market gives it up, folks. You got the NASDAQ 100 down now 127 points. Give me 1 second while I zoom in on the action here. And there's your drop-off. Quite a drop-off. We have a low of yesterday of 15,762. We're now within about 100 points of that level. You look where we were. We were trading, folks, at the open at a price point of 16,090. So what is that? we just dropped 160, 250 points in the NASDAQ 100 in a heartbeat. We go from decent positive territory to negative territory. You get the Dow off 108, the Russell right now off 1.5%. Russell trading at 2170. Not really having to do with the market, but an interesting tidbit nonetheless I saw out on Twitter this morning. Yesterday's date was both a palindrome and an ambigram. I am not familiar with the term ambigram. I am now, but that means that it can be read upside down. So yesterday's date was both a palindrome and an ambigram, which means it can be read backwards and forwards as well as upside down. Not too familiar with many other dates like that. 12/02/2021. You put that in a calculator, flip it forward, reverse, or upside down, and you get the same thing. 12/02/2021. Cool nonetheless is what I thought, so I thought I'd share it all with you. All right, folks, jumping around. Let's jump around to some of those FANG stocks. Because, man, talk about a reversal in the NASDAQ 100 that had held up pretty well. We have Apple shares only down 0.3% right now. As I mentioned, right, when I jumped around to all these stocks, what was that, 5-10 minutes ago? They were all in the positive. You now have Microsoft down 0.5%. You have Apple down as well. We have Google shares still in the positive by about 0.1%, so barely in the positive for Google shares. Let's jump to Tesla. Tesla down about 1.8% right now. We jump to Facebook shares. Facebook shares down about 0.75%. Everything getting hit in this market right now. You get the S&Ps down about 12 points right now, trading at 45.63. As I mentioned, a far cry from the lows we had on, was that late Wednesday? Yes, late Wednesday at 44.97. We were over there as well on the open on Thursday. But keep your eye on this one, folks, because I imagine a missed jobs number with the Fed chairman talking about transitory is no longer the case. That should be cause for concern in the market. It's talking, it's squawking, and you better listen. Thanks so much for tuning in, folks. Stay tuned. We got our man Basil Chapman coming up live right now. Larry's at 11, Fast Market at 12. See Rhodes, Dave White, Tom O'Brien this afternoon. Have a great Friday.